The illusion of permanent stability. It feels solid, dependable, almost permanent. Markets rise, institutions endure, and the system appears to correct itself whenever it stumbles. Yet beneath this calm surface lies a fragile assumption that stability, once achieved, will naturally sustain itself. To understand why this belief matters today, we need to look at how modern finance learned to trust its own resilience. Decades of reforms, safeguards, and technological advances create a sense that the worst failures belong to history. Banks became larger and more diversified. Regulations grew more sophisticated. Data promised foresight. Together, these elements built confidence that shocks could be absorbed without lasting damage. This confidence shaped behavior. Institutions took on greater complexity, believing safeguards would hold. Investors accepted tighter margins, trusting that volatility had been tamed. Policymakers relied on models suggesting that risks were measurable, manageable, and contained. Stability was no longer treated as something fragile and earned. It became an expectation. But stability, when taken for granted, changes how decisions are made. It encourages speed over caution, efficiency over redundancy, growth over resilience. The system begins to optimize for calm periods while quietly weakening its ability to respond to stress. Small vulnerabilities are dismissed as anomalies. Warning signals fade into background noise. The first cracks often appear invisibly. A market reacts too sharply to minor news. Liquidity tightens where it once flowed freely. Correlations rise between assets once thought independent. None of these shifts trigger alarms on their own, but together, they suggest something deeper. The system is becoming more sensitive, not less. This is how the illusion forms. Stability looks permanent because it has not yet been tested in the ways that matter most. The safeguard work until conditions fall outside their assumptions. And when that happens, the calm that once inspired confidence can accelerate uncertainty instead. These early signs do not announce a crisis. They whisper. They ask whether a system designed to prevent collapse has quietly made itself more vulnerable to it, and whether the belief in permanent stability has become one of modern finance's most dangerous blind spots. As the belief in lasting stability settled in, the system began to behave differently, subtly but consistently. Institutions adjusted not for survival, but for efficiency. Buffers were trimmed. Redundancies were removed. Capital was pushed to work harder, faster, and closer to its limits. Each change made sense on its own. Together, they reshaped how risk lived inside the system. Financial models reinforced the shift. They were built on historical patterns that assumed the future would resemble the recent past. Volatility appeared manageable. Crises looked rare and containable. When stress emerged, it was brief, localized, and quickly absorbed. These results fed confidence, and confidence fed expansion. The system learned to trust its own reflection. Liquidity, once treated as something precious, became assumed. Markets evolved to function at high speed, relying on continuous flows of capital that rarely paused. Trading volumes surged. Products multiplied. The ability to exit a position quickly was treated as protection against loss. Few stopped to ask what would happen if everyone tried to exit at the same time. In this environment, risk did not disappear, it migrated. It moved into connections between institutions, into shared assumptions, into structures that only revealed themselves under pressure. Assets that looked diverse began to react in unison. Dependencies formed silently, binding distant sectors together. The system grew smoother on the surface, while becoming more tightly coupled underneath. Policymakers watched these developments with cautious optimism. Stress indicators remained calm. Inflation behaved. Employment held steady. Each successful intervention reinforced the idea that the tools in place were sufficient. The absence of disaster became proof of durability. Stability was no longer questioned. It was measured, projected, and assumed. Yet history offers a quieter lesson. The periods that feel safest are often the ones that invite the most risk-taking. When danger feels distant, preparation fades. The system becomes optimized for normal conditions, even as the range of possible outcomes quietly widens. Stability becomes less about resilience and more about expectation. By the time concern begins to return, the structure has already shifted. Risk is no longer concentrated in obvious places. It is distributed across networks, embedded in behavior, and reinforced by shared belief. The illusion holds not because the system is strong, but because it has not yet been forced to prove it. And when that proof is demanded, it rarely arrives gently. The danger of permanent stability reveals itself when pressure finally enters the system. Not as a shock, but as a test it was never designed to endure. Small disturbances begin to travel farther than expected. A routine policy change tightens conditions more sharply than models predicted. A minor market correction triggers reactions across sectors once considered insulated. The system responds, but not smoothly. It hesitates, then it overreacts. This is where the conflict deepens. Institutions built for efficiency struggle with uncertainty. Their structures, optimized for speed and precision, lack the slack needed to absorb surprise. Decisions that once felt automatic now require judgment under stress. Liquidity, assumed to be abundant, becomes selective. Confidence, once taken for granted, starts to fracture. Markets amplify the strain. Algorithms react faster than human reasoning can intervene. Price movements accelerate, feeding on themselves. Correlations spike as investors seek safety in the same places, abandoning diversification at the exact moment it is needed most. What looked like a well-balanced system begins to move as one. Fragile not because of weakness, but because of uniformity. Inside institutions, pressure exposes hidden dependencies. Funding sources that seem reliable evaporate. Counterparties hesitate. Risk managers discover that their worst-case scenarios were built on assumptions that no longer hold. The models still function, but their outputs lose meaning in a world behaving outside historical boundaries. Policymakers face a narrowing window. Intervene too early, and they risk confirming fears. Intervene too late, and momentum overwhelms control. Each option carries consequences amplified by scale and speed. The tools designed to smooth volatility now confront a system where feedback loops move faster than regulation can follow. Public perception shifts quickly. Headlines focus on sudden instability, ignoring the long period that built it. Confidence retreats not because people understand the mechanics, but because uncertainty has replaced expectation. Trust, once invisible, becomes a central variable in every decision. The system has reached its most vulnerable point, not during collapse, but during realization. The moment when participants understand that stability was conditional, not permanent. That safeguards were designed for familiar stress, not structural surprise. And that resilience was quietly traded away in exchange for efficiency. From here, the outcome depends on how quickly the illusion is replaced with awareness, whether institutions adapt or cling to assumptions already proven fragile. Because when stability is finally questioned, the response determines whether the system bends or breaks. The moment of reckoning arrives when the system is forced to confront what it has become. Stability does not vanish all at once. It fractures. Markets hesitate, then surge. Institutions act, then pause. Each response reveals how much depends on confidence that no longer feels automatic. The illusion dissolves not through collapse, but through exposure. In these moments, emergency measures slow the damage. Liquidity is supplied. Guarantees are announced. Signals are sent to reassure participants that control still exists. And often, these actions work, at least on the surface. Markets stabilize. Panic recedes. The system appears to recover. But the deeper lesson lingers beneath the relief. What becomes clear is that stability was never a permanent state. It was a balance, maintained through vigilance, restraint, and humility. When efficiency replaced resilience, the margin for error narrowed. When models replaced judgment, blind spots widened. And when calm was mistaken for safety, preparation quietly faded. The aftermath forces reflection. Institutions reassess buffers once considered excessive. Policymakers re-examine assumptions embedded in their tools. Investors rediscover the value of uncertainty, not as something to eliminate, but as something to respect. The system adapts, not because it's flawless, but because it has been tested. Yet the cycle never truly ends. Over time, memory fades. Safeguards loosen. Confidence returns. The same pressures that once created vulnerability begin to rebuild it in new forms. The illusion of permanent stability waits patiently for the next generation to inherit it. This is a paradox at the heart of modern finance. Stability is strongest when it is questioned, not assumed. Resilience grows when systems are designed to endure surprise, not just optimize normal conditions. And the most dangerous moments often arrive not during chaos, but during extended calm. Understanding this does not prevent crises, but it changes how we prepare for them. It shifts focus from prediction to adaptability, from efficiency to endurance, and it reminds us that stability is not something a system achieves once, but something it must continually earn. Subscribe to join the journey. The